Now let us go to chapter number 3, that is Introduction to Accounting Standards. Now first, you understand what you mean by accounting standards. It means generally accepted model of accounting principles. What accounting principles are followed by your organizations, and you have to follow those sets of model which are set by ICAI. Now who issues these accounting standards? That is Institute of Chartered Accountants of India. And so far there are 32 accounting standards issued by them. Now why it is needed, what is the need and what are the advantages or disadvantages of accounting standards, we are going to study. The first objective is why we need the accounting standard. The objective of issuing accounting standard is to standardize the different accounting policies and practices which are followed by different organizations in their day-to-day life. Now what benefits we are going to use, what benefits are we getting from these accounting standards is it reduces the variations of different policies which is adopted by an organization. When several organizations follow the same accounting policies, same accounting principle, definitely it helps in comparison of financial statements of one organization for different period as well as of different organization for the same period. So it becomes easy for us, but there are certain limitations of it also. Sometimes this accounting standards becomes mechanical. Even though you don't need to follow, but as it is compulsory, you go on following. So it becomes a mechanical process also. Sometimes your accounting standard may differ from the law. So law says one thing and the accounting standard say one thing. So that the variation comes. And sometimes the cost of implementing this accounting standards also becomes very high. Anyway, everything has a pros and cons itself. So we have to follow this. Now one by one we are going to study. But of course you only have 4 accounting standards in this syllabus. Accounting standard 1, 6, 9 and 10. The first one we are going to study is Accounting Standard 1, that is Disclosure of Accounting Policies. Now first let us understand, as it is an Accounting Standard 1 and it is the base of all the accounting standards, this accounting standards is compulsory for all organizations in India. If you want to run a business in India, if you want to follow the accounting standards, this accounting standards is very much important and it is compulsory. That is one, AS1. AS, when I say AS, that is accounting standards. So AS1, that is the name of the accounting standard, is Disclosure of Accounting Policies. Now first let us understand what is accounting policies and what are the disclosures which is required. Then we will come to know what is the AS1 says. So accounting policies means what? It means it says which accounting policies should be followed by organization in preparation of their financial accounts. While preparing a financial account, when I'm preparing a trading P&L and a balance sheet, which accounting policies should be followed in my business organization, by my business organization. Now what do you mean by accounting policy? It means it refers to the specific accounting principles, and you can say methods of applying those principles in your business organization while preparing your financial sets of books. Now, it is compulsory from 1st of April 1991, and what are the main features or a requirement of AS1 is that whatever the significant accounting policies you are following or whatever the accounting policies are followed by your organization, it should be adopted in the preparation and presentation of financial statement should be disclosed. When you prepare your financial statement, whatever the accounting policies you are following, it should be disclosed. Such disclosure should form part of your final accounts also. And when you disclose such accounting policies, it becomes part of your financial statement, and you should disclose all significant accounting policies in your financial statement at one single place. Rather than scattering at various places, don't do that, but disclose at one single place so that everybody can easily refer it. Next one is, if the fundamental accounting assumption, what are the fundamental accounting assumptions? There are 3 fundamental accounting which we saw previously, that is going concern, consistency and accrual. If they are followed by your organization, definitely no disclosure is required, because by hook or crook you have to follow that. I told earlier also. But if it is not followed by your organization, then the disclosure becomes compulsory. It is required to disclose why you are not following fundamental accounting assumption. Now, any change in your policy within a year or during a particular year or from 1 year to another year should become part of your disclosure. Why the change is required, why and for what reason you have changed the accounting policy, and such change should also become part of your financial accounts. Now when you change any policy or when you change from one policy to another policy, definitely there will be either a surplus or there will be a deficiency. So both, whatever may be the result, whether it is a surplus or whether it is a deficiency, it should be disclosed in your P&L account. If it is a surplus, it should be disclosed. If it is a deficiency also, then also it should be disclosed. Now, when you change any policy, definitely the amount by which an item is affected in a financial statement, that also should be disclosed. Like suppose if you are changing depreciation method from straight line method to WDV method, then amount of depreciation will be different. So that amount you should disclose. Now whenever there is a certainty in disclosure of your amount, definitely you should disclose the amount. But when you are not able to calculate the amount, like by what amount or by which amount there will be a change, then you should mention that there will be a change or any possibility of changing. Nearby about possibility, you should disclose in that. So wherever there is a certainty of change in amount, you should disclose that amount, by what amount your financial effects or your financial transactions are affected or it is being changed. When you cannot calculate the amount, you disclose the fact, like because of so and so reason my policies are changing from here to there. Next, where the amount is not ascertainable, definitely the fact should be disclosed. So that is your main feature or requirement of AS 1. Understood? Thank you.